Yeah.
Here we go. This meeting is being live streamed.
Got it.
It's 10:30 a.m. Unbelievably, we got away on time on the West Coast, 1:30 p.m. on the East Coast. It's value after hours. What's happening, fellas?
Yeah.
Yeah.
The hype man is a little bit flat.
Yeah, we need to get those. Oh, Jesus. Then he leaves. Well, the show must go on.
Oh, we lost him already.
Yeah. Better to lose him early than, I guess, when he's mid saying something important.
Was it you last time who bailed out?
I think we all take turns with
I disappeared a few weeks ago, didn't I? I forgot that. Hey, London, Ontario. What's your topic today, JT? What do you got on the?
Well, I'm an unabashed Mauboussin fanboy. All in.
Aren't we all?
Standing hard for him. So I will be doing a little update, hitting the highlights of his latest piece that came out that's called Turn and Face the Strange. So I appreciate him going David Bowie reference too there. So hi, Michael.
I like the name. Yeah, I got a few on deck for today. I kind of want to talk about, we're going to go back into China, talk about Alibaba. And it's like a little bit macro. This is a little bit politics. I don't really know exactly what's going on.
This is where we're at our best.
Yeah, everybody's going to love this.
And then there's a book, Dopamine Nation, which talks about the addiction of gambling a little bit. And there are these 4 signs of like gambling addiction, or why you become the environments that create gambling addiction. And I'm just gonna like at the same time mention the fact that there are now as many brokerage accounts in the States as there are households, which is a big ramp from where they were. But I'll get to that when we get there. What are you talking about, Billy?
I'm probably just gonna listen to you guys, and then I'm gonna riff on this.
So you did nothing to prepare, is what you're saying?
No, I did. It's just Toby said he's got like 3 topics.
Yeah, he's going big today.
There's a reasonably good chance that we'll at least get through 30 minutes talking about his if we actually get into it. And I've got some stuff to riff on about yours. So let's see where it goes.
Let's start with UTC. I want to get into
which one do you want to? Well, let me do one and then the other. I've kind of got 2 topics here, so I'll do. Do you want to start with China, or do you want?
Yeah, no. What was your? Oh, your third was the brokerage.
Well, it was just the households. Yeah, the brokerage accounts and the households. So let's start with there's a book, Dopamine Nation. Lemke is the last name. And I got this from a podcast that I did last week with Dr. Richard Smith, who's a risk guy, and he said there are the 4 ways that you can induce this sort of gambling addiction, or the environments that induce a gambling addiction. You need to be able to get a reward. That creates
not value investing.
Yeah, well, occasionally value investing might be the worst of the lot. I'll tell you why. Anticipating a reward is part of it too. So looking forward to getting the reward is as important as getting the reward.
There you go.
You also need a rich, complex environment with lots of learning opportunities. So that's investing. And if you're in an app where you've got all of the fireworks and the confetti going off, that's probably helpful too. And then your reward needs to be highly randomized, and best is about 50-50, because that amps up your anticipation and your reward receiving as well. And it gives you an outsized thrill when you actually get the reward. And I just thought this is a factoid. I learned this from Vincent Delward yesterday. There are currently as many brokerage accounts as there are households in the US, and this is a big step up from recent times. So I looked at the start of the year. There were 100 million at the start of the year brokerage accounts. There are about 122 million households in the US. In 2013, which was the last time I could get data, there were 17 million brokerage accounts. So In 8 years, we've put on
5x almost
83 million plus brokerage accounts. But in 2001, there were 19 million. So in 2013, there were fewer than there were in 2001.
It's because they got blowed up.
I think that's what happened. And then there was a long time of the market sort of going backwards. Like you remember from 2000 to 2013, SPY was flat or backwards.
That's no fireworks.
There's not much fun there. And it's been like on a vertical ramp since about that time to today. So that's probably why there's a lot more brokerage accounts. What do you guys think?
Sell everything. Oh, I'm just kidding.
This is not a market call. This is just,
Oh, okay.
You know, have we, you know, there's a particular provider who we are always sort of dunking on, but have they sort of mindfully or have they knowingly like created this environment where it's incredibly easy to sign up now and it's incredibly easy to trade. And then you've got these, they're meeting all of the 4 criteria for inducing a gambling addiction in somebody.
Yeah, I don't know. I mean, I I want to be like, fuck them, but I don't know that thought's right. As it pertains to Robinhood specifically, the idea that they, at least historically, have not provided the customer service is atrocious. The actual inducement of people to sign up for brokerage accounts does not bother me that much. And even like options trading, I mean, the only reason that I'm doing what I'm doing is that I came in through options trading. So like, I don't know. I have really mixed feelings. I don't like the gamification. And I don't like the idea that discount brokerages can just like basically provide absolutely no support and then just like say, well, you know, externalities are to the rest of society and we don't have any responsibility. Like that really bothers me. But, you know, I don't know. I guess I would need to know the definition of a brokerage account. You know, if like a brokerage account can have $5 in it, then how much are we really talking about? You know, my
there's
intuition.
Probably quite a few of those around, right? There's probably quite a few. I mean, I've probably got one that I've forgotten from 20 years ago.
How much was the last STEMI check? It's probably about how much is in there.
No, probably less if people are trading it, but
oh yeah.
The average is quite high. The average is like 300. Well, the last data that I saw, this is the 2013 data, but the average was like $357,000 in the account. Now, averages
we need
are
median
skewed.
Probably better.
Yeah, averages are skewed. That was just all the data that I had. It's actually pretty hard to track down that data. I tried to Google around for it, couldn't pick it up.
If Google can't do it, no one can.
Yeah, well, that's fair. I mean, Vincent would know.
Yeah, I don't know. I mean, certainly would be one of the things that you could tick onto the late cycle indicators if you were so inclined.
Something Toby and I were talking about before we started today was that the digitization of a lot of these things, these habits, these activities really hides it from us in society, like what is happening. So like imagine if you had to go down to the bucket shop and like they had all these people hanging around and trying to, you know, read the tape and do all this stuff. Or imagine everyone going to the sports betting parlor and they're all hanging around there all day. And we saw that as society. Like, would we look at that and go like, maybe this isn't the best thing for us as a species to have these people doing all of this kind of, you know, basically gambling behavior. But because it's on your phone and we don't know what you're really doing on your phone at any moment.
That might be the healthiest thing you can do on your phone.
Yeah, exactly. I mean,
I think
it's all swiping right and dropping coin on. But yeah, I mean, I think there is something like sort of interesting about how it's now been removed from our view in general.
Yeah. Yeah, I mean, I guess like what I'm thinking about with the brokerage account specifically is like, I don't know that I trust a lot of Mao numbers. I don't know that I trust a lot like monthly average users. I don't know that I trust a lot of the daily average users. Like, I think there's a lot of data. Because I just think a lot of it's like bullshit, whether it's like
they're just making it up to make it look more.
No, I don't know that it's like as nefarious as fraud, but like, so I I went to college with a girl who just lost her husband. And like I signed on to Facebook to check that. I'm a monthly active user. What does that mean? Like I literally signed on because it's the only place that I knew how to send her a message. I sent her a message and I got off. Right? Like now I think when your sample size is large enough, people could push back and they could be like, well, that'll show up through ARPU. And, you know, if you're not seeing ads, then the revenues are, you know, like it's a balancing act. But I just think that it doesn't tell you about the quality of engagement on a lot of these platforms, and then like how engagement is shifting. And I don't know. I think there's a lot of data, and I'm sure that in large numbers, it's reliable, but I just sort of don't know what conclusions to draw from each individual data point.
I'm sure that there are a lot, you know, the 17 million brokerage accounts in 2013 with a average $350,000 in it, they were probably a lot more engaged and serious in using them than the 100 million plus that, you know, I might even have a Robinhood account because I tried to sign up one day to have a look at it and see how it worked. And I've never used it since. That might count as one of those brokerage accounts. I don't know.
Yeah, like I'm almost certain I do too, because I wanted to see what it was like. And I guess I have my $2 coal stock that they gave me. Thanks for that, assholes.
I don't think I got a free stock. I think I probably signed it before that.
I think they always give you a free stock to induce you to trade.
Remember.
Right? They give you something you don't want, then you sell it.
Sell
and
it.
You realize how easy it is to sell it.
Pretty
so
clever.
You buy something else, and all of a sudden you're a trader, and then they get to tell you that it's because they're getting you into investing.
What innings does that mean we're in, Bill? Someone wants the update.
I mean, I don't know. It's hard to look at what's gone on. Forget about the index. There's a lot of carnage in this market from the highs. So maybe we're in the 10th.
I'll tell you one thing interesting that I saw was that I just randomly turned on Bloomberg late on Sunday night, and I saw they had this. There's a little piece on China, which I won't. I think JT should go before I come back to the China part because I don't want to do it all the way through. But the peak of the MSCI China index was February 17th, which is about the same time that everything tech kind of peaked over here too. I don't know what that means. I just noticed. I thought it was odd.
Yeah, I mean, what's going on in the Russell? I bet that peaked probably around a similar time.
Well, ARK was February 12th. I just looked that up immediately just to sort of see. So they were about 5 days apart. Tesla was a little bit earlier.
I guess the Russell's pretty flat this year, huh? That's interesting.
Which one?
The Russell 2000. I mean, it's pretty much flat since February. I would have thought it was down.
Did it have a big ramp and then a big fallback?
Not really. It's just kind of in this like consolidation pattern. Some would call it a bull flag.
Bull flag.
You're looking at a bull flag off of these March bottoms. Breaks out to the upside. You could have a real nice run. Could go to 3,000 on the bull flag. You want big volume when it breaks out, though.
That kind of language is probably going to make this podcast break out. That's exactly what we need.
We've also got we're sitting in the consolidation pattern. You're looking at a 200-point consolidation pattern. I'm telling you, that breaks out on big volume. You got to buy it. Smash the bid.
This is great. I love this. I could listen to this all day.
I don't know what the candlesticks are. I got a line chart up here. Maybe I can switch that over and get you some Harami. Isn't Harami, or is that wasn't a, was that,
I don't know if that's something you can
is that
eat.
an ape? I don't know what it was. Anyway.
Bill, I wanted to know though, did you buy an NFT yet?
No, man, I'm not going to do that shit, but I do like them. I don't have the money. If somebody wants to give me money, like, you know,
they gotta have cheap ones, don't they? Like
go fund my NFT. I'm not going to buy
collectibles
NFT.
But mate, if you buy for
on the internet,
if you buy one for $100 and it runs up to 100 million, like that's how you turn into a legend,
dude. It's the way I view it is you're trying to signal something on the internet. You don't try to go out and signal something in a Hyundai.
Got it.
You know, like that's not the game I'm trying to play.
Yeah, you can't flex with a $2 NFT.
That's right. No one cares. You can pick up what, like 20 followers?
That's a day at the office for you.
Jeez, I do that in my sleep. Anyway.
JT, do you want to do yours, and then we'll come back to the China one? I don't know if that's the least or the most.
Everybody wants the China thoughts, man.
Well, I don't have any thoughts. I just got stuff that I've read that I'm going to throw at you guys. Some quotes, see what you think.
Yeah, right. People are clamoring for it.
Yeah, boy. They came to the wrong podcast then, probably, if they want.
There's nobody clamoring for anything on this podcast.
Yeah, just clamoring
China
for us
and
to
macro.
Stop. All right, let's jump into some Mauboussin then, and and then we can come back to give the people what they want. This is what we want right now. So his latest piece is about like sports teams and investing, and there's a ton of parallels. I think some of it is not quite always like lines up perfectly, just because of some of the constraints that sports teams face. Like drafts and things. Like there's exclusivity to a player, whereas if you're assuming you're not too big, like there's not much exclusivity on an investment. You tend to be able to kind of buy whatever you want, right? But so it starts out by saying like sports teams, they're trying to maximize two things: winning on one hand, kind of operationally, and then also profits for the club. And so the first thing to ask is really like what contributes to winning, especially in a changing environment. And it's like it's the players, it's the strategies, it's the tactics that should lead to winning. But for some reason, sports franchises are generally very slow to change. Why is that? And this whole paper is basically trying to address like, why is that? And to give an example, talking about 3-point shooting in the NBA, like the expected value of a 3-point shot, like basically the shooting percentage times the number of points that you get when you make one, is higher than like a mid-range jumper, which you shoot at a little bit higher percentage, but it's only worth 2 instead of 3. And this expected value, when the 3-point shot first came about, like no one was shooting them. Like they just thought like, this is too far away to shoot. Even Larry Bird was kind of like anti the 3-pointer, even though he was a terrific shooter. But eventually teams realized, well, dang, if we like get better at this and have our players practice shooting threes, maybe we can like score more points that way. And it actually crossed over in 1990 when the 3-pointer was a higher expected value shot than the mid-range 2-pointer. And yet it wasn't until like 2014 when teams actually started taking more 3-pointers than mid-range shots. So like, why did it take 25 years? Basically, you could almost kind of use that observation that science like Max Planck observed that science advances one funeral at a time. Maybe the same thing as, sports science advances one GM can at a time. But so Daryl Morey was kind of one of the first ones to realize that. He was the GM of the Houston Rockets for a long time. Now he's I think the GM of the 76ers, but he observed that when you shoot more threes than mid-range twos, that equated to like 12 more wins in a season, which is almost the equivalent of adding $30 million to your salary, to your payroll. So then Mauboussin observes that this 3-point idea is pretty well out of the bag now. Like it's been competed away. And now the next thing might actually be like offensive rebounding. So like teams have traditionally not sent everyone to crash the boards to get an extra possession and an extra shot, because they're worried about getting back on defense. And so there's some kind of game theory playing out there potentially right now. So then we sort of zoom out, like what is it that is, why is change impeded? Like why are these teams so slow to change? And Mauboussin puts forth 3 different reasons, all of them behavioral ideas basically. But the first one is loss aversion. And this is kind of Keynes' classic thing about it's dangerous to fail unconventionally, right? Like it's better to just, for your job prospects, to fail conventionally and not stand out and get fired, right? And like basically only the really losing teams or the winning teams that have enough goodwill to try new things with their fans are in the sweet spot enough to be able to try out these novel and like experiments. And everyone is most of the time are stuck in the middle and they can't really get out of the middle because of that. Number 2 is the status quo bias, which is where we favor doing whatever we were doing, right? Like there's an inaction and like neutral, like we observe inaction as kind of a neutral thing. Whereas if you take an action and it was wrong, then you get fired for that, right? So there's also the endowment effect where the GMs will hire, like they'll re-sign players for higher than they should have on a kind of base rate if they were just to hire them, as a free agent. And then there's sunk costs. Like the teams are more likely to play their first round picks as opposed to later picks, even if the later ones are proving to be better players. So we're like, we spent a first rounder on this guy. We got to play him, see what we have. Right. And then the third reason is sample size. So there's lots of randomness in any given year. Sometimes a guy will be a terrific shooter and sometimes he'll just have a terrible night and you'll lose. Right. And there's the tactics that are supported by analytics don't always work, right? Like it's a statistical thing where you have an expected outcome, but you don't always get it. And so thinking about like hitting into like when teams do the shift, right? Like let's say there's a lefty up and they move everyone over to the right side of the field. And then it's a ball that gets hit that looks like it should go right to where the shortstop is. There's nobody there, right? So that's a base hit. And you go, what are you doing, right? Like, and those are like very painful for the fans and for the pitcher, maybe, where like, God, I just got the ground ball to short and there's nobody there to make the play. But we don't notice as much when the guy rockets one, into towards where the second baseman wouldn't have been. And the guy who's playing in the shift gets it and gets the out, right? Like, so it's all about playing percentages. And the last thing here is like the importance of time horizons. So the NBA average for the number of seasons with a team for a player is 1.9 years. So this is like pretty short turnover, right? It's an average of like 2 years that you're going to be with a team. A coach is 2.5 years. The GM is 4.9 years. The owner is 10.9 years. So the example of this is the last year, the New York Jets were 0-13 going into week 14. And the perfectly logical thing for everyone upstream of the coach would have been to lose these next 3 games, get the number 1 pick and go get Trevor Lawrence, right? Like that's who everybody wanted. Instead, the coach, has, because he's on a shorter time horizon, goes and they win 2 out of the next 3 and they don't get the number 1 pick, right? So like you have these time mismatches. So another interesting thing here is that they've done some really cool work on what they call draft capital. So like, what is the number 7 pick in the first round worth relative to the number 15 pick in the second round, let's say. And so there's kind of different scoring that you can use for that to figure out like what is a particular pick worth. And that's sort of based on what the expected value is of a mid-range or a mid-round second pick. Like what do they typically produce? And so like the Browns from 2017 to 2018 were in full rebuild, full tank mode. And they actually built up like almost 2 extra drafts worth of draft capital for the subsequent years by trading away their reasonably good players then for picks later. So basically like kind of optimizing draft capital over a different time period than just that 1 year. And it's allowed them to rebuild in kind of a reasonable way. The Dolphins and the Jags have been doing something similar recently. Last thing, maybe the most interesting, Albert Pujols, right? Cardinals, first ballot, obvious Hall of Famer. 2011, he's 31 years old, and he signed the Angels signed him to a 10-year, $240 million contract, right? And based on like what observed, like he contributed about $40 million worth of team value of production, of baseball production to the Angels over that time period. So it was like a $200 million hole that was created in relative to what they paid. And that happens a lot. So I thought it would be kind of fun for us to throw it out there to the chat, as well as I'd like to get your 2 guys' ideas on what is the possible like Albert Pujols in 2011 today? Like what's the stock that has done Hall of Famer right up until now, but maybe long in the tooth and you don't want to sign him to that 10-year and very expensive $240 million contract?
Does the reason why it took, so it was like 1990, they figured out that shots, 3 points were worth more than 2 pointers, basically, because on average, you get a little bit more. And then it takes until 2013. Is that like is that Steph Curry or someone like that comes into the league and starts? Is it too early for him?
No, go ahead.
I don't think it was him, but go ahead, Jake.
No, I think it was just statistically the players actually started training on the 3-point shot a lot more. So you had these guys that were like, they just park them in the corner, right? And they shoot.
Yeah, like Kyle Korver, guys like that would just like sit there and shoot threes. The Suns were like one of the first run and gun 3-point shooting teams. Mike D'Antoni. I might be wrong on that, but that's a version of the truth I'm going to tell.
I just wonder I don't know if it was like, when Moneyball came out, it's not that the A's were doing anything that was like the structure had been created for the A's to do exactly what they were doing. It just seemed like nobody was really exploiting that the way that the A's were. And now everybody's sort of aware of the Moneyball phenomenon. Every single club's probably got the data guy who can tell you, which position you should have. And maybe it just took a little while for that to bleed into basketball, just took a little bit longer. And now they're aware. Now everything's they've got data on everything and they're tracking all that stuff.
Yeah. And I mean, part of it is how hard is it to measure things? So like hockey is harder to measure than baseball, which has very discrete actions. Like you either made an out or you didn't. Like, but the hockey equivalent of that is like, well, were you in the right place or not? Like, so until you had player tracking, it was a much harder thing to keep track of. Like basketball is kind of the same way too. Like it's a more fluid game. So it's harder to measure, like what, maybe like the effectiveness of driving in, or like who's good at spacing themselves. Like, who finds an open spot. Like those are harder things. They're a little bit more subjective maybe than just purely like this guy got a hit, or even measuring like the exit velocity of the ball in baseball, which could, correlates well with hits. So a lot of it has to do with the sport itself that's intrinsic to it.
Investing doesn't really suffer from that because there's a lot of data, but there are a lot of other confounding factors too, but there's also a lot of data. There's a couple of good suggestions in the chat. One is Peloton and the other one is Tesla. Tesla's almost like probably the most obvious one, but Peloton's interesting.
Yeah, I don't know.
I would say it's kind of early for that one. Like Peloton to me seems like coming off of their rookie contract and about to sign a big contract, but it's not sure whether like maybe they put up some good numbers, but maybe they weren't like they're expecting a really big payday. I don't know.
I guess Zoom's in the same idea as Zoom, right?
Yeah, I just think those companies are so young that they're not a great Pujols.
Agreed.
They're not a great like Pujols comp yet.
What about Tesla then? Tesla's got the age, got the valuation.
Yeah, maybe. I don't know. I think anybody that shorts a guy that shot 4 random civilians into space is out of their fucking minds.
I'm not saying necessarily short it. Like you clearly can't short that stock, but like just in terms of underperforming the index for the next decade.
Yeah, could work. I don't know. I have no idea where the Colt will bid it to. I would be like more. I don't know.
It's not really about bid though. It's about production versus price.
Yeah, like beer as a category would make me nervous to pay up for. CPG continues to be so. Like, I don't know. People are going to hate this, but if you need one. The thing about Pujols is I think that they knew that he wasn't going to be worth the back end of the contract. I mean, that's sort of the unique thing in sports, right? Is you're bringing him in for what you hope to be a World Series or something. But there's part of me that wants to say, watch out for some of the narrative around luxury.
Yeah, but you don't sign a 10-year contract for a guy like that when you're trying to win today, right? Like you put him on a 2 or 5 year. 10 years, that's a big commitment.
Yeah, but I think if you think you can win today and you got Mike Trout, you pay him what you need to. I don't know. It's a dick measuring contest at certain stages. It's not like an investment portfolio, right?
There's also marketing, right, for those guys. Like you want to hold on to players who are well known and liked, and people go and buy their shirts with their names on the back.
Yeah, and I think like you can bring in. I mean, you don't want to pay a guy $30 million to just coach up young guys, but a guy like Pujols was so well respected that I think having him in the clubhouse can go a long way. There's some non-monetary benefits.
Apple. Got a couple of suggestions here. Apple and Facebook. Theranos, good one.
Yeah, I can
Boeing,
maybe get
PNG.
down with Apple. I'm starting to like kind of hate Apple.
Why?
I don't know. They're just like some big tax on the internet. It's so not.
Oh, the App Store.
Yeah, and I mean, like, it's funny just like dealing with this super follows on Twitter. I mean, like, Apple gets 30% for what? Like half my Twitter activity, 75% of my Twitter activity is through the desktop. And the only reason that Apple gets to pay is because they're processing payment through the App Store. And like people think Visa and MasterCard are taking too much. Like, get out of here.
Well, why do it through the App Store? Isn't that Twitter's fault? Can't they arrange it some other way?
Yeah, they could, but like fuck Apple too. Like I think it's not good forget about me as a creator. Who gives a shit about me? But like the entire internet, like they're gonna take 30% of digital. That's anti-innovation. That's just the
internet will route around it eventually. People will route around it eventually.
I get it. I'm just saying that's not Apple to me. Apple was an innovative company that put consumer need first. And now it's just like some extractionary moat based on software and whatnot. Like, that's lame. That's what Microsoft used to be in the late 90s. That's not inspiring. That's like,
why pay them then?
Because I don't want to text in green.
But you don't have to pay. Like, what? I'm not saying you. I'm saying why does Twitter pay them? Or do you pay them? How does it work? I don't know. I haven't done it.
No, well, Twitter's building this particular thing on iOS. I mean, it's not. Companies are starting to get outside of the ecosystem. I understand that workarounds are like working or starting to happen. This is the whole Apple Epic Gaming thing, but like they're still massively extractionary. And it's not in any way beneficial to society, in my opinion, other than the fact that if you're a Berkshire fanboy, it's helped you. And I happen to be one. So that's nice. But like, they're not like an innovative, exciting company. They suck.
You're not excited for the iPhone 13?
Yeah, like the AirPods were dope. I got love for the AirPods. And I mean, I guess the watch is fine and stuff, but I don't know. I just find that it's not an inspiring business model to me anymore.
Isn't the iPad coming out in a slightly different size?
Yeah, right. And like, that's what it is. It's all, I use luxury tech because I want to signal that I'm a luxury human, and like that's what it is. And like, that's
gonna have a big diamond embedded in my forehead.
Yeah, but I mean, brands matter. I guess this is kind of an interesting. Mad Thunderdome and I were kind of going back and forth on the Twitter machine on Saturday, and his comment was like, or the question that spurred us going back and forth, and I don't even think we're that far apart, but is like, is brand an asset or is brand a moat? And I had used Lululemon as an example, but I think Apple applies too, on like brand enabling a company to make supernormal profits. But I think he and I would probably agree that a brand is closer to a strategic asset than a moat. But then I would get to go further and say, well, like, is anything a moat, right? You could argue low cost is a moat, but really execution's the moat. So I think execution is really always the moat when you really cut down to the core, because anything else can sort of be like destroyed.
Brands are more important when you're browsing a shopping aisle, right? And you've got limited time to get the thing that you want, and you just want looking for that thing, get it off the shelf and keep going. It's different when, and this is a problem for CPG, right? That I don't know what different avenues are being used, but is it like social? Is that how they're selling that stuff now?
Yeah. I don't know that I agree with your comment on brands though. Like Lululemon, I think traditional, I think people like to wear it because it says something about them.
Well, you can go on Instagram right now and you can buy lots of brands that have a very similar looking logo.
Yeah. Well, that's fine. But then, like, if you're a woman and you bend over in yoga class, you're probably going to show your thong, which is what almost ruined Lululemon for a little while. Their pants.
They've got the better technology,
Yeah,
better
I
seat
guess.
technology.
It feels good, right? But they had problems with their execution for a little while. Their quality got shitty, and they almost lost it, but then they got it back.
It's a good segue for China.
All right, let's do China. So the thing I saw on Sunday night on Bloomberg, there's been this Deng Xiaoping, who is a premier of China, whatever the leader of China is called. He had this philosophy that sort of to embrace capitalism with the idea that would allow some people to get rich at a faster rate, or some people to get rich first, and that was going to be okay. But Mao Zedong had this philosophy called common prosperity. And it seems now that Xi Jinping is trying to bring back this idea of common prosperity. This is a term that keeps on turning up in quotations from people in authority. And so the implication is that that's what we're seeing, or the tech crackdown. There are other things going on in an attempt to like this. It is sort of an explicit move towards more socialism. I don't know if that's like the Western media's interpretation of what is actually happening, or whether that's what is actually happening. But would that change your view on, say, does it make investing in tech in China or Baba or any other sort of stocks, does that make them less attractive?
Not even one bit.
It doesn't change anything.
September 10th, I tweeted out to somebody asked when I was talking to Roy Ma, which should come out here in the near future. Would love to hear you ask her about capital controls and the inability of companies to return capital to their shareholders abroad. I said, I'm taking that one even further and asking whether there's a massive off-balance sheet encumbrance, because the government will end up requiring donations back to society rather than shareholder profits. I think if you haven't been considering this, you're not paying any attention to how China works.
They do seem to be requiring very large philanthropic, or there have been some leaders who've come out and said,
yeah,
we're going to make
it's a
$15
fucking
billion.
Socialist country, or communist country. Like, what did people? I don't. It's hard. I'll tell you, the hard thing for me to understand is, if we're worried about Chinese tech, how have the questions around Starbucks profitability and Nike's profitability in that country not come into question? Because it's hard for me to understand how you can be worried about Chinese tech companies making too much money and not giving it back to the people, but somehow Nike making humongous margins off the people of China and extracting it and sending it all over the world. Like, we don't think the Chinese government has some level of insight into Nike's margins in China.
It's less visible, I guess.
Yeah, but we don't think like the Chinese government has some level of control to say to Nike, like, you're either going to make massive donations back to this country or you're not going to sell stuff here anymore. Like, if we're going to ask these questions on Chinese tech, I think you have to ask the questions of everything in China.
Well, what does that do then?
I don't know.
China growth is lower going forward. China profitability is lower going forward for US companies participating there.
Or this is Western media and Western interpretation run amok. But I think that's part of the bet that's being offered in the market. And that's where you get to have your variant view and either make your money or lose it.
Which way do you lean?
What do you think about?
I lean towards, if I was forced to bet one way or the other, I'd be long Chinese tech.
Maybe we can zoom out a little bit and think about this. Like the point
I'm not
of
forced to bet.
the.
That's what's nice.
Yeah, you're not. Let's think about if we look at it kind of on a longer timeline, and a lot of the purpose, I think, of this rhetoric or legislation, or however it gets expressed, is to actually create more stability, right? Like, one thing that leads to instability is often very large discrepancies in incomes and net worth historically. That's typically what has led to revolutions. So I think that the CCP probably wants to get out in front of that before there's enough tension built up in haves and have-nots to even that out a little bit more so that there's maybe more stability for a longer period of time. Now that's like a working theory. I don't know if that's necessarily true. I'm not sure you can actually like make stability disappear that easily, but it does kind of like, we're trying it a different way here where we're just letting a lot of inequality build up. And is that working out particularly well here? I don't know. Like, I'm not sure over what timeline, but these are all really hard problems to solve. Like, they're choosing a different way of trying to solve it. I don't know. Yeah, like, I mean, I'm a little bit less judgmental about it, I guess.
I totally agree with you. And I think this is where Charlie falls on it. And I think this is why Charlie was okay buying Alibaba. Is I think that if you believe that a lot of years of cash flow are what you're buying, having a country that you perceive to be doing things in an effective way, reduce the amount of inequality and extend the duration of your society and the aggregate wealth can potentially result in a good outcome. I have no idea how to handicap it. I was born in America. I voted for Ron Paul once upon a time. I find top-down economics very fucking like offensive to everything that I believe in. At the same time, assigning a high degree of confidence to the fact that they're doing the wrong thing is very, very hard for me to do. And I think that, we'll see. But I've always thought that no matter what happens, whoever's right is going to pretend that they knew what was going to happen, and they're going to say, see, I told you. And I think the range of outcomes is pretty wide here. As far as, I'm not sure that you can be certain on whether or not this is the right thing to do or the wrong thing.
It's not so much whether it's right or wrong. It's just, it's a matter of like what the implications of what they're doing are for those companies that are listed there. And, it might, what the right thing for their society might be completely the wrong thing for those companies. And I don't know how it's going to fall out either. I'm just sort of interested in following it because I find it's kind of an interesting experiment that you get to see in real time.
Like, here's the thing though, the education system, like what they were doing was atrocious, what they were doing to children.
Which country? China.
And yeah. And like how hard children were working. And then like teachers weren't teaching in class to divert children into after school for-profit tutoring. Like, fuck those companies. I got no problem with them going under. I think this is part of what Charlie says, that when he says like, I wish that I could wave a wand in certain areas of the US and make things disappear. I mean, the difference is over there, they can. So I think if you're operating from like Peter Kaufman's win-win-win strategy, and part of your win is the government, and you're thinking about the people, my gut tells me that you're probably not as in danger of the government coming after you. But over there, it's always a risk. And I think if you like anyone that invested that didn't think it was a risk, I don't think has their eyes open.
What about
have you tried running a small business in California? I mean, it's like we have plenty of things here that are also not that much different, I feel like. So I don't know. I just feel like we're a little bit of a glass house throwing a lot of stones.
I think that I think that the thing that you said that resonates the most with me is like, I look at how our country has handled the hollowing out of the middle class, and the idea that that is a stable system to me is like just kind of offensive. And I think I don't want to live in China. I understand that in China they can take everything from you for saying something, and it's absolute power, and I get all that. I'm not advocating for what they have, but I think people are way, way, way too certain they're right or wrong either way. That's my only strong opinion.
What about Evergrande? You guys followed that at all? As like some sort of, the suggestion is that it's the Lehman moment, and I don't know if that's for the US or for China. I assume it's for China, but I've got some quotes here. UBS says it's not Lehman. Dalio says it's manageable.
Subprime is contained.
So it did sound a little bit like that, didn't it?
Sells everything China related and tells everybody it's manageable. Just hit the bid while I sell
trash.
Yeah.
Yeah. S&P came out with default likely without support.
Okay. What does that mean?
Well, I guess the S&P is just like I guess that means unless China steps in and bails them out, is the default is going to occur. I don't know what the implications are. I haven't followed the story really closely. I just find that it's one of those things that's making a lot of noise at the moment, probably because people are following it in the press. But it's interesting, just a very wide range of outcomes. UBS saying it's not Lehman, but then S&P coming out and saying it's default likely without support. And then I guess you could add Dalio onto the end of that, where he says it's manageable, in the sense that, they are gonna bail them out.
Yeah, or if they go down, it's not going to take everything with it, right? But I don't know. I have followed this situation. I have no idea how to quantify the risk. I think that it's hard to live through 2009. Look at how financial risk went throughout the system and not at least have your, ears perked up at it.
Fingers of instability, they call it.
Yeah. I always get nervous with finance. Like I think total return swaps, like all these derivatives, credit exposure, like it's always concerning to me.
One of the short guys, Carson Block or Muddy Waters, I realize it's Muddy Waters, but someone, Citron, somebody else has been pointing out Evergrande as an issue for more than a decade.
Yeah.
It's hard to be short in this market, I gotta say.
Yeah.
Those timelines on the extinction events can be longer than you think.
Yeah, indeed. And the other problem is that everything is a bloody Lehman moment too. Every single thing that occurs is someone saying this is the Lehman moment for this market. There have been half a dozen over the last year or so.
Yeah.
Yeah, of course.
This is why I don't have strong opinions on it.
That's why you shouldn't read the news.
I try not to.
Well,
except on Tuesday morning for about 15 minutes before you get on.
When I open Twitter to see what's happening.
I do think that the Wall Street Journal article on China was interesting, but I have a lot of questions about why we're hearing about this now. And I don't know that I have a good answer.
Well, ask the questions.
I mean, that's mostly the question that I ask myself, is just like, why now?
Why are we hearing this now?
Yeah, like, and who's leaking it and for what purpose and what's really going on behind the scenes? Like, I'm much more interested in those answers than the words on the page.
Yeah, I think, yeah.
It's just how I look at the news. I don't even care about the story as much as I care about who are the sources of the story. Why are they speaking out now? Who's trying to signal what?
That's epsilon theory. That's a great question. Yeah. I often think that too.
I think that's the only thing that matters, because the rest is just PR.
What do you make of the fact that MSCI China peaked around February? Like everything kind of peaked around the same time. ARK peaked, China peaked, Tesla peaked, all the tech companies kind of peaked.
Weed stocks peaked.
Was it weed stocks?
Yeah, I feel bad that I did my 420 episode, but I can't help it when the weed holiday happens and when the market peaks. That's not on me. But yeah, I think a lot of things went like risk off. It's been interesting to watch things trade recently, man. Like, I guess weed stocks, February 10th. Look at that. That's interesting. I think it's kind of coming out of a speculative time.
Yeah, well, that's kind of my any stock market crash that I go back other than 87 and probably March 2020 has been preceded by like basically a year of chopping sideways before anything happens, and then like 6 months of terror. 100
million new accounts. There's no action. This is boring now. Like it's not scratching that gambler itch, right? Stuff trading sideways or choppy is not.
It's not
that
fun.
Exciting. It's not that much fun. So you lose interest and you go find something else to gamble on.
You need someone to sell an NFT for $68 million and get the people excited again.
I mean, the thing that's crazy though, like you're talking about, just looking at the weed stocks.
Go back to the lotto.
MSOS, and I don't know if this is a split or what, but I mean, you're looking at it's off from $120 a share to $29.34.
What was the stock? What was
MSOS, it's like the wheat ETF.
Mm.
I mean, now I don't know how real that trade was. Maybe that's like a wrong print on Bloomberg or whatever, but it's easily down from 40 to 29, easily. But the screen that I'm looking at has $140 a share down to 40. So I don't know. Oh, maybe I'm looking at total return. Sorry, my bad.
But there was a big special dividend.
No, I think I'm looking at the wrong thing. Hang on. Sorry.
Riveting.
Jeez. Oh,
Retail.
Shut up.
When did retail go back to work? Retail had to go back to work. I saw an interesting thing yesterday about the number of people who work from home telecommuting. If you ask people who telecommute, they massively overestimate the number of people that work from home at the absolute peak of the pandemic. And they also overestimate how many people are going on now. Just what do you guys, what would you guess for how many people were working from home at the peak of the pandemic and how, as a proportion of the working population? And now, as a proportion of the working population, how many people are still working from home? Throw your guesses in the chat too. I'll let everybody know in a moment.
Ooh.
Hang on, I just want to correct the record. MSOS is off from 55 to 29. That's a reasonable correction. And that's a lot of different things, man. A lot. That's what I think is hard about looking at the index.
You don't know how concentrated though. Like if it's market cap weighted and they're big into the one thing that's come back off a lot, then that could easily explain that.
Well, you can follow that whole sector, but I'm just talking about there's a lot of stocks that are off bigly. Yes, a lot. So you want me to throw out my really dumb guess on how many people were working outside
at the peak? At the peak, how many were working from home? At the peak of the pandemic and now?
I don't know. I don't even know how to think through this. I feel like this is a trick question. I'm passing.
It is a trick question.
This is one of those like cognitive reflection tests. Like a bat and a ball is $1.10.
That's right. It depends a little bit on if you're working from home. You people who are working from home guess 70% at the peak and down to like 40% now. And the number that I saw was 35% at the peak, and it's about 13% now. So basically, 39%, 18%. That's pretty good. That's a pretty good guess.
13% right now are working from home.
Yeah.
That's it?
Yeah.
Huh.
So all of these discussions about like people going back to the office and all that sort of stuff, like
they
this
already
is
went.
really, it doesn't affect most people.
Or they're not working at all. What was the
Maybe a little bit of both. I don't know. They got a few jobs. They got a few brokerage accounts and a few jobs.
You don't need a job if you got that brokerage account that just keeps going up. That's
right.
That's the new way to spread the wealth.
Beats working.
Interesting. That's quite low.
So what's your sense now? Like where are we in? What innings are we in? You gonna say 10?
I don't know what fucking inning we're in. I have no idea. I mean, I don't know. There's a lot of stuff that's really beat up. A lot. There's a lot of stuff that's not. But even the stuff that was ripping and stuff. I mean, like, I don't know. Give me like a really growth name. Like
Shopify.
Well, Shopify is a juggernaut. You can't stop that. But
there's a lot of carnage, right? But there's not, the index is all-time highs.
Yeah, well, I think that the issue is a lot of people think that these businesses are going to be really good for a really long time. And I guess that I don't, if you think that, I don't know why it would change anytime in the near future.
They do have
it changes
a good like 5 years worth of conditioning of like the S&P 5 just carrying the weight in a major way. And the S&P 495 not really doing anything that special. So there's a lot of conditioning in that right now.
I mean, there's like a balance between, valuations imply Maubussin's concept of a competitive advantage period. Like the higher the valuations go, the more that you're implying the competitive advantage period has to sustain. So to me, with these valuations, doesn't make a whole. Yeah, well, it just doesn't make a lot of sense that would change tomorrow, but it also can. I mean, it's people are fickle. But
I would question
I don't know why
too,
it would stop.
so much of it is based on advertising. So selling eyeballs is a huge part of the market cap.
Yeah. But a lot of it though is like subscription businesses and enterprise software and stuff like that. And
yeah,
I don't know. We're probably early innings because I'm getting tired of the innings question. That's how my contrarian answer is.
Yeah.
Oh yeah, second
Possible.
inning.
Is it the flows that keep the index so strong, or is it that 5?
Well, it's those 5, but they get a disproportionate amount of the flows, right? Like this, I don't know how the chicken or the egg works on that thing. I'm not smart enough to figure out these questions.
What about the Fed? How much of that is Fed printing?
Oh, it's
got to
all
be something,
Fed.
right?
It's all Fed.
I mean, there's a lot of Fed printing going on there. That the numbers are like was it you, JT, who said 100? The balance sheet, the Fed balance sheet's up 140% over the last 12 months.
I think from like September of 2019, I think I saw that the Fed balance sheet's 140% higher today.
I mean, if I don't know where that, the stock market, maybe it's a slightly different beast, but would you see that in housing prices? Would you see that in real estate?
Well, I think housing, you got rates plus there's just no supply. Like we don't have enough houses.
But it was all pretty flat until sort of pre-March 2020. And it just seems to have like ramped since then.
February 2020, it broke out. You got to listen to my pod with Logan.
What happened?
Oh, I mean, it's a humongous demographic thing that he's been talking about coming through. The demographics through 2024 are just incredible. And, I think that the story that people told themselves was millennials don't want to live in houses. And what they didn't realize is millennials just don't want kids till they're 30 because they're probably going to live till 85. So they're going to live in a city and romp around with each other for a little bit longer. But like women have to have kids by 35 to 40. You just like, there's only so much you can do to keep that off. And that's where the millennial age curve is coming up. So once you have babies, living in a city sucks.
So
some of
people
you
were
may
holding
want
off.
to do it, but yeah.
And then they realized that the window was closing and they've all tried to get through the window at the same time.
Well, they're starting to get through the window. I think his argument would be we could have 4 more years of. I think Logan's most bearish assessment of housing from like a healthy versus unhealthy market perspective is that prices just absolutely rip from here
in housing.
And yeah, and he calls that unhealthy because then you have people that are like truly priced out and left behind. Like he doesn't view that as a healthy market.
I mean, house prices where I have looked have been up about 20% year on year, which is a 100% increase in deposit. Sorry, that's not right. It's a big move up.
Yeah, no, it's huge. And like my mom's out in Arizona. She's saying that like they're offering like 10% over ask in cash and you can't get the house.
Yeah, I heard that from one guy 2 times, a real estate agent who coaches my daughter's soccer team. He told me that he'd had 2 houses go 300 and 400 over the ask.
But that's like
weekend.
a housing. That's like a housing. You got to look at like housing inventory days, and they're insanely tight. Does it always happen? I don't know, but
I mean, this is your inflation you've been looking for, right? Like, because it's the same house that it was 2 years ago. It's the same roof over your head, but now you pay 20%, 100% more in property taxes. You pay 100% more in, because I have to insure $1 million for this piece of property that was $400,000 5 years ago, right? Like there's no actual gain there for you if you're going to have to go buy another house that's just as expensive.
Yeah, I think the real question then becomes, does this create an incentive for builders to build more?
Hope so.
Yeah, I don't know. You would think capitalism might solve it, but if they don't, we could live in a perpetual shortage for a while.
On that note, that's time, fellas. Thanks, everybody.
Cheers, everyone.
See you next week.